Local vehicle sales figures jumped 11% in December to 43,000 units. George Nyabadza, General Manager of the Marketing and Public Sector Division at WesBank, joins us in studio now to unpack the numbers for us. George, thanks so much for joining us this afternoon. Well, there we have it. Sales up 11% year on year. And if we were factoring in a conservative estimate for Mercedes-Benz sales, which were excluded from this account of numbers, many saying we could have actually touched 14.5% for the December period. In line with your expectations? In line with our expectations, and this time of the year we always have a smile.
Before the results come out, we have a bit of a dread because WesBank goes out and publicly declares where we think numbers would be. Our CEO in February said to be in 15.2% year-on-year increase for the year, and he was spot on, because although the numbers show 11%, but excluding Mercedes-Benz, there's been two sets of numbers run. We've looked at taking what Mercedes-Benz sold in November and assumed that it would be the same level, would have come up at 15.5%. And then the statistical company that runs the data did a whole lot of clever numbers around it, looking at seasonality and all sorts of influences, and they said 16%. So our 15.2% prediction was accurate.
Take us through this rationale for Mercedes-Benz stopping now with reporting new vehicle and export sales figures, because it's a directive that's been given by the German parent company Daimler, and that as it's investigated by the European Union for a violation of antitrust rules. So some see this reporting as being anti-competitive.
Unfortunately, I probably have as much information as you. I mean, the notification we got when we got the data was that Mercedes-Benz excluded because of that directive from Germany. And as of now, we don't understand why, we don't know why, and probably to become clearer in the next few weeks.
Okay, so we wait for some detail there to emerge. In the meantime, let's unpack these numbers even further and drill down into passenger sales, because it's particularly your affordable and low entry vehicles that made a statement through the course of last year. Just how sustainable a trend is that as we move into 2012?
I think it's relatively sustainable. From the first quarter of last year, we started noticing, and when we reported at our indicator where we get a dealer confidence, the first quarter was 6.5 out of 10, and the second quarter was the same. And what came out then was a significant level of buying down. In other words, if Alicia and George had cars, next time around we go and buy a car that's 20–30% cheaper. So that's where we saw the growth. I guess you could call it the entry-level vehicles in the 100–120,000 segment, and that carried on throughout the year. Almost the same kind of trend that you see in houses. People are buying down to because of affordability. What's good about that is that coming out of the downturn that we had, I think the consumers now know how to manage their debt, and they're staying in vehicles. What we've seen in terms of replacement cycles, where replacement cycles were pushed all the way up to the 50-month level, they've dropped significantly. Used cars have been replaced much quicker, just less than 30 months, and new vehicles have been replaced quicker. So people are staying in vehicles, but the majority are buying down. Again, add that to the new entrants. There is always a fair level of growth and new entrants in the marketplace.
Of course, you say buying down is one of the ways the consumer is looking to address that affordability constraint that it faces. So what about financing terms? Because we've explored this issue before, where consumers have started looking at longer terms of addressing affordability constraints that way, while balloon values have pretty much remained stable.
Yeah, that's happened. I mean, the NCA has really afforded us the ability to go a bit longer. So we've seen a lot of applications, probably the majority coming through now at 72 months, because you still work out the affordability, etc. If someone can afford over 72 months, they get the credit. So there's a lot more applications with longer terms, so that I can pay much lower than I could pay if I was at 5 months, for example, and that will continue. And that's quite legit, because we have to, as banks look at affordability, we can't have reckless lending. So I think we're in good ground with respect to that.
So what's your assessment of the quality of applications that are actually coming to your desk at the moment? Because a number of consumers are still out there with impaired credit records, and that remains high. It's sitting at around about 47% of the total credit active consumer base in South Africa.
Right. There's been quite a noticeable, let's call it structural change in terms of the quality of applications coming through. I mean, in the early days, and we're talking at the height of the recession, we used to process a lot of applications, and then we had a lot of declines as well, because people just couldn't afford it. But what we noticed in the past year, although applications peaked in October, where we just crossed the 111,000 applications a month level, they're much cleaner. There is less declines that are coming through. Consumers have done a lot of their own homework, and they're taking advantage of some of the tools that a lot of finance companies like WesBank have, and our competitors have, application tools online where you can check your affordability, the dealer flow, irrespective of who you're dealing with, and which branch you can take advice of from the finance insurance. So that is happening quite a lot, and we're seeing what is submitted has been thought through. So there is less declines, there's more approvals coming through. So
how's activity within the passenger sales market comparing to the likes of medium to large commercial vehicles? Because that was just as much a contributor to sales growth in the November period. Yeah,
there's a bit of a lead and lag that happens with the motor industry. When a recession hits or hardships are upon us, the passenger side is hit hardest first. That's where we see the problems. That's where we see the brakes coming on, and then your commercial side, your light and heavies, takes a bit of time to get hit by any economic hardships. Similarly, when the reverse comes in, the passenger side kicks up well first. That's why we're seeing a lot of strength and activity in the new and used. And only in the last 2 quarters of this year that's just closed have we seen increased activity on the commercial side. So there's been quite a good contribution there. I mean, rentals have come in quite well. Your light commercials have come in quite well, again indicating increased economic activity across different sectors of the industry.
Of course, we've had industry sales for 2011 up about 15.9%, and that in line with expectations, where we had the industry expecting anything between a 15 and 16% rise for the 2011 period. Moving into 2012, what's your outlook? Because at the end of last year, we had APSA saying they're anticipating a more tepid 5% increase this year.
Well, we're a lot more accurate. I'd love to give you a figure now, but I know our CEO is still running the numbers. But what I can tell you in terms of the inputs that go into that data that we're crunching, we look at various factors. We have some concerns. If I can start off with that, interest rates were flat last year. Of course, that worked positively for the consumers. If you look at inflation ending at about 6.1, and starting off at 3.5, there's been a growth there. If you have a growth in inflation and flat interest rates, there's a chance that you might start getting interest rate hikes. So if that comes through, we think there's a possibility of a hike coming through sometime this year. That would have an impact on sales. But again, there's always a bit of a lag, so that may not hit us that much in this particular year. But consumers are aware of what's happening. There's issues happening in the Eurozone. Complete uncertainty just playing out there. Also, that may have an impact on manufacturers. However, manufacturers have come through the Japanese earthquake and the Thai floods quite well, so they're pretty prepared. There's what Eskom has announced this morning, the possibility of power cuts. I mean, last year, this time, they were talking about the same thing, so I'd love to think manufacturers have taken that into account, but you never know the impact and how that might affect sales. But the dealers themselves were very positive. Last year, the biggest thing that dropped our confidence level from 6.5 to 6.1 was the impact of the earthquake and the floods. Now that is worked through. There's a lot of confidence coming through in the industry. So I think we're going to be still close to the early double digits growth, but we'll give you a more accurate figure in February.
Well, we'll chat then. George, thanks so much for your time this afternoon. Of course, George Nyabadza is General Manager of the Marketing and Public Sector Division at WesBank.